All right, picture this. You've just sold something big. Maybe it's your house, that old vacation rental, or even a piece of property from your business. You're feeling great, maybe even celebrating a bit.
Hmm.
And then that little voice creeps in. Wait, what about taxes?
Always the question, right?
Exactly. So today we're taking a deep dive into those exact moments specifically, something called non-taxable dispositions.
Right.
We're going to unpack those, well, those truly fascinating scenarios where you sell or exchange an asset. You realize a gain, but the tax bill,
Hmm.
it doesn't hit you immediately, or sometimes it doesn't hit you at all.
Precisely. And we're going to start by setting the foundation, understanding how gains and losses are typically calculated, just the basics.
Yeah.
Then we'll jump into these very specific situations where the tax rules actually allow you to either defer that gain, kind of push it off to a later date, or in some really advantageous cases, exclude it entirely.
Wow. Yeah.
Yeah, this deep dive is essentially your shortcut to understanding some really powerful provisions in tax law.
Our mission here is to break down these seemingly complex rules into easy-to-understand nuggets, focusing not just on the what, but crucially, the why behind them.
Yeah, the why is important.
We'll give you practical examples that hopefully make these concepts stick. Okay, let's unpack this.
Let's do it.
So to truly grasp non-taxable dispositions, we first need to understand the fundamental idea of how gain or loss is determined when you sell something.
Yeah.
It all comes down to a simple comparison, right? What you receive versus what you gave up.
Exactly.
The amount realized is what you get that could be cash, maybe the cancellation of a debt, the fair market value of any property you acquire, minus, selling expenses.
That costs of selling.
You compare that to the adjusted basis of what you're letting go of.
Yeah.
And that basis is usually your original cost, but
Yeah,
it can have special rules for things like gifts or inherited property.
that's right. Basis isn't always just what you paid. Gifts, inheritances, they have their own rules. And this is where the critical distinction comes in. A gain can be realized, meaning on paper, yeah, you've clearly made money,
Okay.
but it might not be recognized. And to recognize a gain means the IRS is going to tax it in the current period.
Ah, okay. So realized doesn't automatically mean taxed now.
Exactly. That distinction is the absolute key to all these non-taxable provisions we're about to explore. And to help you remember them, we use a handy acronym, HIDE IT.
Hide it.
Oh.
Okay, I like mnemonics.
Yeah, it helps. So HIDE IT covers the specific situations where these realized gains are either deferred or completely excluded from your taxable income.
Right.
The core idea behind these provisions is, well, it's quite elegant, really. They generally apply when your investment hasn't substantially changed or when specific circumstances, warrant some relief.
Like you swap something similar.
Exactly. You've simply swapped one form of property for another that's very similar. Or maybe you're replacing something due to an unforeseen event, like a fire or condemnation. Because your underlying investment hasn't fundamentally altered, the tax law allows for this deferral or exclusion, often by carrying over your old basis into the new property.
Got it. Okay, so let's kick off with the H in hide I. What's H?
H is for the homeowner's exclusion. This is about the sale of your personal principal residence.
Ah, the big one for most people.
It really is. And it's fantastic news for many homeowners. It's not just a tax break. It's like a powerful tool that lets you build wealth in your primary home without triggering capital gains right away. Frees up significant funds for, your next big life step.
Okay, so what are the numbers? How much gain can you exclude?
So for married couples filing jointly or certain surviving spouses, you can exclude up to $500,000 of gain, $500,000.
Wow.
Yeah. And if you're single, married filing separately, or head of household, that amount is $250,000. Still very significant.
Definitely. But what about losses? If you sell your house for less than you paid?
Good question. It's important to note, though, that if you sell your personal residence at a loss, that loss is generally not deductible.
Okay, so gains excluded, losses not deducted. Got it. What are the main rules to qualify for this exclusion?
The core criteria. You must have owned and used the property as your principal residence for at least 2 years during the 5-year period ending on the date of sale.
Owned and used. 2 out of the last 5 years.
Exactly. And the great thing is those 2 years don't have to be continuous. They don't even have to cover the same exact 2-year period within that 5 years.
Oh, interesting. So you could live there a year, rent it out, move back for a year, and still qualify.
Precisely. Let's take an example. Imagine Sarah, a single professional. She lives in her home for 1 year, then gets a job offer across the country, rents it out for 2 years. Then maybe she moves back for another year before selling. Even though her use wasn't continuous, she still qualifies because she owned and used it for a total of 2 years within that 5-year window. The key is just the total time within that 5-year look back.
That's clear. What about married couples? Any specific twists there?
Yeah, there is a key difference. For the full $500,000 exclusion, generally one spouse needs to meet the ownership requirement, but both spouses must meet the use requirement.
Both have to live there for 2 years.
Essentially, yes. Both need to meet that 2 out of 5-year use test. So consider John and Mary. John owns and lives in a home for 3 years. Then he marries Mary and she moves in. 1 year later, they sell.
Right.
Even though they're filing jointly and John easily meets the ownership and use tests, Mary only lived there for 1 year.
So she doesn't meet the 2-year use test.
Right. So their exclusion is limited to $250,000 even on a joint return because Mary hasn't met the use requirement for that full period.
That's a crucial detail. That could definitely catch some people off guard.
It can.
Now, you mentioned surviving spouses earlier. Is there a special rule there?
Yes, on a more hopeful note, there's good news. If a surviving spouse sells a home they owned and occupied with the deceased spouse and they sell it within 2 years of that spouse's death, they can generally still claim the full $500,000 exclusion.
That's helpful. And are there age limits or anything? Do you have to buy another house?
Nope, no age requirement, no need to buy another home to qualify. Plus, it's renewable. You can use this exclusion as often as you qualify, provided you don't use it more than once every 2 years.
Okay, every 2 years. Good to know. Now, this next part sounds really interesting, the hardship provision. What if life throws you a curveball? You don't meet the 2-year rule? Or maybe you just used the exclusion recently.
Yeah, this is a great safety net, really designed for fairness. A reduced exclusion might still be available if the sale is due to unforeseen circumstances.
It's like what kind of circumstances?
Well, the main ones are a significant change in employment, specifically, if your new job is at least 50 miles farther from your home than your old job was.
50 miles, that's specific.
It is. Or health issues requiring a move, or other qualifying unforeseen events defined by the IRS.
Okay, so if you qualify for hardship, how does the reduced exclusion work?
It's prorated. You basically calculate the fraction of the 2 years you did meet the requirements. So you take the number of months you qualified, ownership and use, divided by 24 months, and multiply that fraction by your maximum exclusion amount, $250K or $500.
Can you give an example?
Sure. Imagine Anna, single taxpayer, buys a home, lives in it for just 1 year, 12 months. Then she unfortunately has to sell due to a serious health diagnosis, say cancer, and realizes a $150,000 gain.
Okay, so she only has 1 year, not 2.
Right. She doesn't meet the 2-year test for the full $250,000. But because it's a health-related hardship, she gets a partial exclusion. It would be 12 months divided by 24 months.
So half.
Exactly half. Times her maximum $250,000 exclusion. That gives her a $125,000 exclusion.
So she can exclude $125,000 of her $150,000 gain. The rest is taxed.
Correct. It's directly proportional to the time she did qualify, offering, some much-needed relief in a tough situation.
So just to be clear on that job change thing, if I chose to move for a job that's, say, only 20 miles farther, I'd get nothing under hardship. But 50 miles is the magic number. Is that a hard line?
That 50-mile rule is generally a pretty firm line for the employment-related hardship safe harbor. It's really designed to cover those situations where the job change distance pretty much necessitates finding a new primary residence.
Gotcha. Okay. And then there's this other wrinkle, the non-qualified use provision. This applies to periods the home wasn't your principal residence after 2009.
Yes, for any period of non-qualified use on or after January 1st, 2009, to be precise. Non-qualified use basically means anytime you owned the home but didn't use it as your main home, like renting it out.
Okay, renting it out counts. So how does that affect the exclusion? Does it reduce the $250K or $500K amounts?
That's a common misconception. It actually doesn't reduce the exclusion amount itself. Instead, it reduces the amount of gain that is eligible for the exclusion.
Ah, okay. It makes some of the gain taxable. How do you figure out how much?
You calculate the portion of the gain that's not eligible. You take the total period of non-qualified use after 2008, divide it by the total period you own the property, and multiply that fraction by your total gain.
Okay, let's try an example for that too.
All right. Consider David. He lives in his home for 1 year, then he rents it out for 2 years, then he moves back in for another year before selling it. Total ownership, 4 years. He sells it for a $50,000 gain.
So he meets a 2 out of 5 year test because he lived there year 1 and year 4.
Correct.
Yeah.
But those 2 years he rented it out, that's non-qualified use.
Right.
So you take the 2 years of non-qualified use, divide by the 4 years of total ownership, that's 50%.
Okay.
Multiply that 50% by his total gain of $50,000. That means $25,000 of his gain is not eligible for the exclusion and becomes taxable.
And the other $25,000 is excludable.
Yes, the remaining $25,000 is excludable under the normal rule since he met the ownership and use tests. It really ties the tax benefit to the actual time it was your main home.
But there's a little bit of good news here, right? What if the house is just empty while you're trying to sell it? Does that count as non-qualified use?
Exactly. That's a great point. No, generally, a period where the house is empty after you move out while you're actively trying to sell it does not count as non-qualified use.
Ah, that's a relief.
Yeah. So if you lived there 4 years, moved out, and it sat empty for sale for, say, a year before selling, that empty year doesn't hurt your eligible gain calculation, as long as you still meet the 2 out of 5 year ownership and use test looking back from the sale date.
Okay, that covers planned sales pretty well. But what about situations totally out of your control? That brings us to the first I and hide it, involuntary conversions.
Right. This covers things like destruction, theft, seizure, or condemnation, basically, losing your property involuntarily.
Why is there a special rule here?
Well, the rationale is really about fairness. It would seem quite unfair to tax someone on a gain when they're essentially just replacing property because of some unforeseen event, something beyond their control. The goal is to allow them to restore their prior position without undue tax hardship. So the general rule is no gain is recognized if you receive similar property directly as a replacement, or if you reinvest all the insurance proceeds or condemnation award into similar property within a certain time.
Okay, all the money has to be reinvested to avoid gain. What if you don't reinvest everything? Maybe you pocket some cash.
Good question. Then gain is recognized, but only up to the amount of proceeds you did not reinvest.
Ah, so the recognized gain is limited to the cash you kept.
Exactly. And there are specific reinvestment periods you have to meet. Generally, it's 2 years after the close of the taxable year in which you first realized any part of the gain.
2 years, always.
Not always. It's longer in some cases. You get 4 years if it's your principal residence destroyed in a federally declared disaster area.
Okay.
And you get 3 years for real property used in a business or held for investment if it's condemned or seized.
And the replacement property has to be similar or related in service or use. How does that compare to like kind?
That's a key point. The similar or related in service or use standard for involuntary conversions is actually a bit narrower or stricter than the like-kind standard we'll talk about later for exchanges.
Okay, narrower. And what about the basis of the new property?
If you receive property directly, the basis just substitutes it carries over from the old property. If you buy replacement property by reinvesting proceeds, the basis of the new property is its cost, decreased by any gain you didn't recognize, the deferred gain.
So the deferred gain reduces your basis going forward.
Precisely. For example, if McIntyre's land, basis $30,000, is condemned, and the state gives him a similar parcel of land as compensation, the basis of that new land is just $30,000. Simple carryover.
Okay, what about a cash example?
Let's take Cred's building. Basis $400,000, it's
Right.
condemned, and he receives a $450,000 reward. He quickly buys a new similar building for $440,000.
So he realized a $50,000 gain, $450K minus $400K.
Correct. He realized $50K,
Yeah.
but he only reinvested $440,000 of the $450,000 he received. He kept $10,000.
Ah, so he recognizes $10,000 a gain.
Exactly. He only recognizes $10,000 of gain, the amount not reinvested. The remaining $40,000 of gain, $50K realized minus $10 recognized, is deferred.
And that deferred gain affects the new building's basis.
Yes. The basis of his new building becomes its cost, $440,000, minus that $40,000 deferred gain. So the new basis is $400,000. This really shows how deferral works. It's all built into adjusting the basis of the replacement property.
That makes perfect sense for gains. Trying to be fair. But what's the flip side? What if someone has a loss in an involuntary conversion? does that get deferred too?
Excellent question. No, these involuntary conversion rules, the deferral part, they only apply to gains.
Only gains.
Only gains. If you have a loss from an involuntary conversion, say, insurance proceeds are less than your basis, that loss is recognized immediately, assuming it's deductible, like for business or investment property. There's no deferral for losses here.
Okay, so losses are recognized right away.
Yeah.
And the basis of new property.
If you replace the property after a loss, the basis of the new property is simply its replacement cost. No adjustments for the loss. So if Rigoli's factory, basis $340,000, burns down, and insurance pays only $330,000.
That's a $10,000 loss.
Right. That $10,000 loss is recognized right away, assuming it's business property. If he then buys a new factory for $500,000, its basis is just $500,000.
Okay, clear distinction between gains and losses there. Next up in Hyde IT is D. What's D stand for?
D is for divorce property settlement.
Ah, a situation that can be incredibly complex in life, but you're saying for tax purposes, maybe not so much.
You're absolutely right. Tax-wise, it's surprisingly straightforward, relatively speaking.
Yeah.
Property transfers that happen as part of a divorce settlement are generally treated as a non-taxable event.
Non-taxable, so no gain or loss recognized by either person.
Correct. No gain or loss recognized by the spouse transferring the property and the spouse receiving the property. They take what's called a carryover basis.
Carryover basis, meaning they get the same basis the transferring spouse had.
Exactly. They step into the shoes of the transferor regarding the basis. The holding period for capital gains purposes also carries over.
That simplifies things quite a bit during a tough time.
It does, and what's fascinating here is that this non-taxable treatment generally applies even if the liabilities on the property, like a mortgage, exceed the property's adjusted basis. There's an exception for transfers into trust, but generally, even underwater property can be transferred tax-free in a divorce. It's designed to avoid triggering taxes during the division of marital assets.
Okay, that makes sense. Moving on to the first E in Hyde IT. This sounds like a big one.
It is. E is for exchange of like-kind business investment real property. You probably know this as a 1031 exchange.
Yes, 1031. I hear about this a lot, especially for real estate investors. It seems like a really powerful tool for them.
It absolutely is. For investors, this isn't just about deferring tax once. It's potentially a way to perpetually roll over gains from one investment property to the next, building a much larger real estate portfolio over time, often without paying capital gains tax along the way. It's a core strategy for serious wealth building in real estate.
Wow. Okay, so what's the key rule? What qualifies?
Crucial clarification here. Since the tax changes a few years ago, this only applies to exchanges of real property, and that real property must be used in a trade or business or held for investment.
Real property only, so no more exchange like company trucks or equipment.
Exactly. Personal property, vehicles, equipment, collectibles, even intangible assets like patents no longer qualifies for a like-kind exchange treatment. It's strictly real estate now. Oh, and it also excludes real property held primarily for sale, like a developer's inventory, and real property located in different countries. You can't swap U.S. property for foreign property under 1031.
Got it. Real property, business, or investment use within the same country. Can you give an example of what works and what doesn't?
Sure. Let's say a taxpayer exchanges a small office building where she ran her consulting business for an apartment building that she plans to rent out.
Both are real estate. One business, one investment.
Right. That does qualify because both are real property used for business or investment purposes.
Okay. And an example of what doesn't qualify anymore.
Okay, imagine a business owner exchanges some old company laptop computers for a brand new office desk and maybe some filing cabinets.
That's all personal property.
Exactly. Laptops, desks, cabinets, all tangible personal property. That exchange doesn't qualify for non-recognition treatment anymore. Any gain on the laptops would be recognized.
That's a huge change from the old rules. Okay, what about timing? I hear the 1031 timing rules are incredibly strict.
They are notoriously strict. You miss them, the whole deferral is gone. There are two key deadlines. First, you must identify the potential replacement property or properties in writing within 45 days after you transfer your original property.
45 days to just identify it. Okay.
And second, you must actually receive the like-kind replacement property by the earlier of two dates. Either 180 days after you transferred your original property or the due date, including extensions, of your income tax return for the year the transfer occurred.
180 days total, or your tax deadline of that sooner? And no wiggle room.
Absolutely no flexibility on those deadlines. Miss the 45-day identification or the 180-day receipt deadline, and the entire gain on your original property becomes taxable in the year you sold it.
Okay, critical deadlines. Now let's get into this thing called boot. What happens when the exchange isn't purely property for property?
Right. Often exchanges aren't perfectly balanced. Boot is basically anything you receive in the exchange that is not like-kind property.
So cash is the obvious example.
Cash is the most common boot, yes. But it also includes receiving property that doesn't qualify as like-kind, like personal property thrown into a real estate deal, or, very importantly, being relieved of debt.
Relief from debt counts as boot received.
Yes. If the property you give up has a mortgage and the other party takes over that mortgage or pays it off, the amount of that debt relief is generally treated as boot received by you.
Okay, so what's the consequence of receiving boot?
When you receive boot, gain is recognized, but, and this is key, only up to the lesser of two amounts. Either the total gain you realize on the exchange or the total amount of boot you received.
Lesser realized gain or boot received. So you never recognize more gain than you actually realize, even if you got a ton of boot.
Correct. The recognized gain is capped at your realized gain.
And what if I pay boot? Like I add cash to make the deal work.
Good point. It's important to stress that only boot received potentially triggers gain recognition. If you pay boot, like adding cash or taking on more debt than you were relieved of, that does not trigger gain recognition for you.
Okay, only boot received matters for recognizing gain. You mentioned netting debt. How does that work?
Right. If you're relieved of debt on the property you give up, but you also assume debt on the property you receive, you can net those amounts. Only the net debt relief minus debt assumed, is treated as boot received.
Ah, okay, so if I'm relieved of a $100 gate, but take on $80 gate debt, I only have $20 boot from the debt part.
Exactly. You've effectively received $20 in net debt relief, and that $20 counts towards the total boot received calculation.
Let's try an example with boot.
Okay. Say a taxpayer exchanges investment real estate. Basis is $25,000. Fair market value is $40,000. They swap it for new investment real estate worth $35,000, plus they get $5,000 in cash.
Okay, value given up is $40K, basis was $25K, so the realized gain is $15,000.
Perfect. Realized gain is $15,000. Now, how much boot did they receive?
Just the $5,000 cash.
Right. So the gain recognized is the lesser of the $15,000 realized gain or the $5,000 boot received.
Which is $5,000.
Exactly. So $5,000 of the gain is recognized and taxed now. The remaining $10,000 of gain, $15K realized, $5K recognized, is deferred.
Deferred. And that deferred gain must affect the basis of the new property, right?
Yeah.
Like with involuntary conversions.
It does. Same principle. The basis of the new property you receive in a like-kind exchange generally starts with the basis of the old property you gave up. Or an easier way to calculate it is often take the fair market value, FMV, of the new property received, subtract the deferred gain, and add any deferred loss, though losses are handled differently.
So FMV minus deferred gain, using that last example. New property FMV was $35,000. Deferred gain was $10,000.
So the basis of the new property would be $35,000 minus $10,000, which equals $25,000.
Which happens to be the same as the basis of the old property they gave up.
In that simple example, yes. When boot is involved, the FMV minus deferred gain calculation is often the most straightforward way to get the right basis.
Okay. What about losses in a 1031 exchange? You mentioned deferred loss.
Right. This is a strict rule.
Yep.
In a like-kind exchange, realized losses are never recognized.
Yep.
Never recognized at the time of the exchange. They are always deferred. And unlike gains, that deferred loss actually increases the basis of the new property you receive.
Increases the basis. Huh. So you get the tax benefit of loss later, maybe when you sell the new property.
Exactly. The higher basis means less gain or a bigger loss down the road. It's a strict non-recognition rule for losses in 1031s.
Okay, these boot and basis rules can get a bit tangled. Maybe walk us through a few quick scenarios just to see the principles. We don't need all the math, just the outcome.
Absolutely. Quick hits can clarify.
Scenario 1. Simple exchange, warehouse for warehouse. No cash, no debt changes. Realized gain of $3,000.
Okay, pure like-kind, no boot received.
Yeah.
Result, zero gain recognized. The full $3,000 gain is deferred. Basis of new warehouse carries over from old.
Scenario 2. Same exchange, but this time it results in a realized loss of $3,000.
Ah, realized loss. Result, zero loss recognized. Remember, losses are never recognized in a 1031. The $3,000 loss is deferred, and it increases the basis of the new warehouse.
Okay. Scenario 3. Realized gain of $3,000, but you receive $3,500 in cash boot.
Boot received, $3,500 is more than realized gain, $3,000. Result, recognized gain is limited to the realized gain. So, $3,000 gain is recognized, no deferred gain left. Basis of new property is essentially its FMV.
Scenario 4. Realized gain of $3,000, but you receive only $2,500 in cash boot.
Okay, boot received, $2,500 gain is recognized. The remaining $500 gain, 3,005 Ks, is deferred, reducing the basis of the new property.
Scenario 5. Realized gain of $3,000, but you pay $2,000 cash boot to the other party.
You paid boot. Result. Paying boot doesn't trigger gain recognition for you. Zero gain recognized. The full $3,000 realized gain is deferred. Paying boot adds to your basis in the new property.
Right. Paying boot is different. Okay, last one. The debt netting. Scenario 6. Realized gain $3,000. You're relieved of $5,000 debt on your old property, but assume $3,000 debt on the new one.
Okay, netting the debt. $5,000 relief minus $3,000 assumed equals $2,000 of net debt relief. That $2,000 counts as boot received.
Okay, $2,000 boot received. Realized gain was $3,000.
So recognized gain is the lesser of the $3,000 realized gain or the $2,000 boot received. Result, $2,000 gain recognized. The remaining $1,000 gain, 3K, 2K, is deferred.
That netting makes a big difference. It really brings home that question. How does seemingly simple debt affect these complex calculations?
It's critical. It's all about how that debt relief is treated as boot received and how netting works. It's often where people get tripped up in 1031s.
Definitely complex but powerful.
Ah.
Okay, moving to the second I in hide it. What's this one?
This I is for installment sale.
Ah, okay. So this is when you sell something, maybe a business or property, but you don't get paid all at once. You get payments over several years.
Exactly. You've sold something, but you've agreed to receive payments over time, with at least one payment coming in a tax year after the year of the sale.
Who typically uses this?
Well, it's generally available for non-merchants selling personal property and non-dealers selling real estate. Basically, people who aren't regularly selling that type of property as inventory. It allows you to spread out your tax bill over the years you receive payments. You can elect out and recognize all the gain immediately, but the default is the installment method.
Okay, so the big benefit is spreading the tax hit. How does it actually work? How do you calculate the gain each year?
The core idea is pretty intuitive. You recognize the gain as you receive the cash, principal payments, that is. There are three main steps.
Okay.
First, calculate your total gross profit on the sale, selling price minus adjusted basis. Second, calculate your gross profit percentage, gross profit divided by selling price.
Got it. Gross profit percentage.
Third, each year, you multiply the principal cash payments you receive that year by that gross profit percentage. The result is the amount of gain you recognize and report on your tax return for that year.
So you only pay tax on the profit portion of each payment as it comes in.
Exactly. Let's use an example. Say you sell property with a $400,000 selling price, and your adjusted basis was $300,000.
Okay, so gross profit is $100,000.
Right. And the gross profit percentage is $100,000 gross profit divided by $400,000 selling price, which is 25%.
25% profit margin.
Yep. Now, let's say in year one, you receive a principal payment of $250,000.
Okay.
To find the gain recognized in year one, you take that $250,000 cash collection and multiply it by the 25% gross profit percentage.
25% of $250,000. That's $62,500.
Precisely. So you recognize $62,500 as gain in year one. The rest of the gain is deferred until you receive more principal payments in later years. It neatly aligns your tax obligation with your actual cash flow from the sale.
That seems much more manageable than paying tax on the whole $100 key gain up front. But what about interest? Surely if you're getting paid over time, there's interest involved too.
Absolutely vital point. Yes, the seller is generally required to charge adequate interest on the unpaid balance in an installment sale. And that interest you receive, that's reported separately as ordinary income. It's not part of the gain calculation using the gross profit percentage.
So the gain is capital gain, usually, but the interest is ordinary income.
Correct. And if you don't charge adequate interest, or if the stated interest is too low, the IRS can step in and apply imputed interest rules. They'll basically recharacterize some of your principal payments as interest, taxing it at ordinary rates.
Good to know. Are there any other quick rules about installment sales? Things to watch out for?
A few key things. Any depreciation recapture on the property sold, that has to be recognized as ordinary income in the year of the sale itself, not spread out over the installments.
Ah, recapture hits up front.
Right. Also, if you take out a loan using the installment obligation as collateral, the loan proceeds might be treated as a payment received, accelerating gain recognition. And finally, the installment method generally isn't available for sales of publicly traded stocks or securities, or for sales between certain related parties if the buyer resells quickly.
Okay, some limitations. Finally, we get to the T in Hide-Outie. What's the last piece?
The T is for treasury and capital stock transactions by a corporation. This one's usually pretty quick.
So this is about companies dealing in their own shares.
Exactly. When a corporation buys back its own stock, treasury stock, or issues its own stock, either new or treasury stock, any gain it might realize from these transactions is generally exempt from income tax.
Exempt, so no tax.
Correct, no tax on the gain. And conversely, if the corporation incurs a loss on these transactions, that loss is disallowed. They can't deduct it.
So basically, corporations don't get taxed, nor do they get tax benefits from dealing in their own stock.
That's the gist of it. It simplifies things for corporate finance and prevents potential manipulation of taxable income through stock transactions.
Okay, so wow, we've covered a lot of ground. Hide IT, homeowners exclusion, involuntary conversions, divorce, exchanges, installment sales, and treasury stock. What's the big picture here? What does this all really mean for someone listening?
Yeah, we journeyed through quite a bit, didn't we? From, selling your personal home and potentially unlocking huge exclusions to swapping complex business properties tax deferred and even spreading out gains over years. It can feel like a bit of a maze sometimes.
It definitely can. But that HIDE IIT acronym helps anchor it.
It does. And I think the biggest takeaway is that fundamental point we started with. Realized gain doesn't always equal recognized gain right away, or sometimes ever.
Right. Just because you made money on paper doesn't mean you owe tax now.
Exactly. Understanding these specific deferral and exclusion provisions, the HIDE IT rules can significantly impact your tax planning and, frankly, your financial flexibility. It's all about recognizing when the tax law says your investment hasn't truly changed enough yet, or when specific circumstances like hardship or an involuntary event warrant a break from immediate taxation.
And these rules, they aren't just for, high-flying investors or tax pros, are they?
Not at all. The homeowner's exclusion affects millions of people. Divorce settlements, unfortunately, are common. Even involuntary conversions can happen to anyone. Knowing these rules can empower you, the listener, to make much more informed decisions about your property, your investments, and, well, your long-term financial health.
It connects to that bigger picture, doesn't it?
Yeah.
That tax law isn't always just about collecting revenue.
Precisely. Sometimes it's designed quite intentionally to facilitate certain types of transactions, like encouraging reinvestment through 1031 exchanges, or to provide necessary relief when life throws those curveballs, like with the hardship provision or involuntary conversions. It shows a different side of the tax code.
So maybe a final thought for people to chew on after listening.
Yeah, how about this? Think about how strategically using these non-taxable disposition rules, maybe especially the like-kind exchange if you own investment property, or maximizing that homeowner's exclusion, how might that actually transform your long-term investment strategy or your plans for property ownership? Could it open up possibilities you hadn't considered?
That's a great question to ponder. How can these rules become active tools in your financial planning? Okay, that's our deep dive for today. We really hope you feel much more well-informed about these sometimes tricky tax rules.
Hope it was helpful.